what's going on, YouTube, and welcome back to Tech Conversations. As always, I'm your host, Guillermo, and as always, I'm not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So I hope you're all having a great day today. It is July 26th, and it is finally Monday tomorrow, which means the stock market will be opened. Hopefully, we see a green day tomorrow, but anything can happen. Now, today I want to talk about selling puts. Okay, and I want to talk about a couple of different things from, talking about the risks involved, taking a look at something you should take a look at before you sell a put, as well as addressing some questions slash statements that I've heard from a couple of you on my channel. Okay, now before we begin, remember to smash that like button and subscribe, guys. It really helps out my channel. It really helps out my videos to get out there, and hopefully more people can come across them and hopefully get a little bit more educated before they start investing in the stock market so that hopefully they don't lose money. So thank you guys so much for your support. I really appreciate everything. And let's get right into this video. So let's start off with AMD. Okay, I'm going to use AMD as my stock for this demo. So remember, if you can't see this button that says trade, whatever stock you're on, options, it's because you don't have it enabled. So to enable it, go into your account, go into settings. There'll be a section that says options trading, and there should be a link or a button that'll say enable options trading. You just need to click on that to enable it, and you should be good to go. So once you can finally see this button, you can click on it, and it'll take you to the options for the stock. Now, if you're new to trading options, I have made a video where I talk about trading options in detail. I'll put a link to that video in the description below. Go ahead and check it out. Now, again, we're going to talk about selling puts specifically in this video. And so again, you can buy options, you can sell options. So we're going to stick with selling. And you can have, there's calls, there's puts. We're going to stick with puts. So firstly, keep in mind, you can choose whatever expiration date you want for your contract. I'm just going to leave it at July 31st. And so here are all the contracts, right? Here are all the puts for AMD expiring on July 31st. And so let's take a look at this contract right here and explain briefly what this means. So remember, if I wanted to sell this put right here, okay, so our strike price here is, as you can see, strike price $69. Okay, so what does that mean? Here's what that means. This means that if AMD, before the end of the day on July 31st, the end of the market day, if the price of AMD falls below $69, okay, then what's going to happen is I'm going to be forced to buy 100 shares of AMD at $69 a share. Okay, and in return for selling this put, me as the seller, I'm going to receive $3.65 per share. Keep in mind, all of these contracts have 100 shares in them, and so I would receive $3.65 times 100, or $365 for doing so. Okay, that's the premium, and that's the most you're going to make from selling this put. And by the way, you keep that premium no matter what. Now, a couple of things to talk about here. Okay, firstly, in order to even sell this put, you need to have in your account on Robinhood whatever the strike price is times $100. Okay, so if I wanted to sell this put, I'd have to have 69 times 100, which is $6,900 in Robinhood. Okay, because when you sell this put, Robinhood's going to take that $6,900 as collateral in case you are forced to buy the 100 shares at $69 a share. Now, let's talk about the risk involved here, okay? Because I don't talk about that a lot, but I want to address it in this video. Well, worst case scenario here, okay, is you purchase the 100 shares of AMD at $69 a share, and then the price of AMD falls to $0. Okay, if that's the case, if that happens, you're gonna lose $6,900 minus the premium you received, which is $365. Okay, and that's a lot of money. Now, the good thing about selling puts is your risk is always well defined. Okay, it's going to be the collateral that you put up minus the premium you received. Okay, the bad thing is sometimes that can be a lot of money, right? Like in this case, you're going to lose over $6,800. And so let's head on over to the options profit calculator. Again, very helpful tool when it comes to visualizing what's happening with a trade. Okay, I'll put a link to this in the description below. Go ahead and check it out. Always graph what trade you're doing so you understand what's happening, what your max risk slash return can be, all that stuff. As you can see, I did AMD again. Gives me the price. And as you can see, I sold a put. In this example, I used a $67 strike price expiring July 31st. And so again, for this, I received $272. Okay, I received that right away. It's in my account. I can, deposit it to my bank, go buy pizza, go buy beer with it, whatever. And so that's the most you're going to make, $272. But again, if we take a look at this estimated return section, my max risk is $6,428. Okay. As you can see, it's going to happen if the price of AMD falls to $0, right? Because again, 6,700 minus $272 is going to be 6,428. Gives me my max return, $272. And on top of that, it gives me a great visual that I can, take a look at and see how much money I would have made depending on what the price of the stock is and what the date is, especially if you want to exit the trade early. Now, again, this can be really risky, right? And that's fine if you don't want to take on this much risk. There's another approach that lets you kind of do the same thing here, but with less risk, right? And I'm talking about this put credit spread. Okay, put credit spread. So it's going to be the exact same process. You're going to sell a put at a $67 strike price expiring July 31st. So this is the exact same put I'm selling in the other example. So you can see I'm receiving $272. But again, that was too risky, right? We didn't want to risk the $6,400 that we were risking. So what you do is you kind of put some protection on it as well, right? And you do that by buying a put with a strike price that's less than the strike price of the put you sold, and it has to have the exact same expiration date. Don't forget that. And so what's going to happen here is for buying this put, I'm going to have to pay to buy it, and I'm going to pay $103. But that's fine. You're still receiving money, right? Because the credit you're getting is greater than the debit that you're going to have to pay, right? And so overall, I'm still going to receive $1.69 per share. Since there's 100 shares, I'm going to receive $169. And so that's the most I'm going to make, right? So your return, your max return is going to be less. But again, so is your max risk. Because if you take a look down here, your max risk now is only $331, right? Versus the $6,400 that you're risking on this one just by selling a put. And keep in mind, these are cash covered puts. Okay, these aren't naked puts; these are cash covered puts. But okay, remember, you can minimize your risk, and that's completely fine. You also don't need as much money, right? Maybe not all of you have $6,700 to put up as collateral. That's fine. You can still do the exact same, a similar thing. And in this one, you'd only need $500 as collateral, and you can find that by subtracting the strike prices, which in this case would be 5 times 100. That's $500, right? Now, why don't I, do these credit spreads instead, right? Since this can be really risky. Well, let's talk about a couple of things here, right? And a couple of statements that I hear from people. First and foremost, selling puts can be very beneficial to those who buy a lot of stock. Okay, and hear me out. Okay, so some people like to say, well, why don't you just purchase 100 shares of AMD and let it sit there? Like it's probably better that way. Well, here's why. Let's say you do want to purchase 100 shares of AMD. If I were to purchase them right now, I'd be paying $69.42 per share. By selling a put, you're potentially agreeing to purchase 100 shares at a particular price that you yourself choose. Okay, if I wanted to buy AMD, but I think it's too expensive right now, and I wanted to buy, let's say, 100 shares of AMD, I can sell a put to potentially buy the stock at an even cheaper price, right? If I think this is too expensive for AMD, I can sell this put right here. And guess what? If it falls below 62, then I buy them at $62 per share. If I purchase them right now this minute, I'm paying $69.42. Okay? So it's a win for me. And on top of that, I'm getting paid, right? I'm getting $102. So that's why, when people say, well, just buy 100 shares right now, it's probably better long run. That's not really a good argument. Now, the other argument, right, that people say, well, this can be really risky. It can fall to $0 and you lose, $6,428. You got to keep in mind that applies to anybody who owns any stock. That applies to any stock, whether you own 100 shares of it or not, right? If we go here to my profile, I have Starbucks, I have Bank of America, Costco, Walmart, Pepsi. I can say the exact same thing about any of those stocks, right? You can say, well, what if Starbucks falls to $0? Well, then I lost 75.55. What if Costco falls to $0? Then I lost $325. So that argument, when you guys say, well, what if it falls to zero? That can be really risky. Yeah, well, you can say that about any stock. Okay. If someone owns one share of Tesla and Tesla falls to $0, what, they're losing like $1,400, right? But you don't hear people telling them that argument, right? So yeah, there's risk involved, but that argument kind of applies to just anybody who owns any amount of any stock. Okay. Now, let's talk about an example here and something you should always take a look at before you sell a put to minimize that potential risk. Okay. And I actually made this video because someone reached out to me on LinkedIn about selling a put on Intel. Okay. Sold a put on Intel last week and we all saw what happened. Intel dropped and it dropped a lot. So you can see it's down 15.41%. That's a lot. Okay. And I want to talk about what you should take a look at here as well as how to avoid this in the future. And I mentioned this in my previous videos. Please avoid trading options in general on stock that have earnings that week. I've mentioned this before. Intel had their earnings last week, and what happened? They came out and they said that their chip, their next generation chip, is going to be delayed. And investors didn't really like that. And what happened? It dropped a lot, right? It's down 15.41%, right? This could have been completely avoided if you guys had avoided trading options on the week that the company announces their earnings. So that's the first thing I would say. Okay, always avoid it. I always avoid it, right? Even if it's my favorite stock, even if it's AMD that I love, I'm avoiding selling puts on it this week coming, right? Because they announced earnings, I think July 28th. Okay, and on top of that, let's talk about some other things that you need to take a look at that I always take a look at. And let's actually go back to AMD quickly here. So again, trade AMD options, and we're going to sell puts. So let's actually take a look at another thing that you should always take a look at. Okay, and I'm talking about implied volatility and this Greek right here that I haven't talked about before, Vega. Okay, so let's go through what both of these two things means and what you should be taking a look at. So implied volatility, as you can see, is a percentage. This is going to tell you how likely it is that this stock is going to have a price swing. Okay, and unfortunately, it doesn't tell you if it's going to go up or down. Okay, it can be up, very high up. It can be down, very high down, or it can be up and down, both, right? But generally speaking, the higher it is, the bigger the price swing is gonna be. Okay, and so as you can see, this is 100%, which is pretty high. Which means there's a pretty good chance that the price of AMD is gonna swing either up, down, or both ways, and it's probably gonna be pretty major. Okay, and as you can see, this is something I always take a look at. Okay, and I want to avoid it, right? And like I mentioned, this is the week that AMD is announcing their earnings, and if we take a look at the $70 one, uh, implied volatility 102%. Okay, and I'm not lying when I say that this is increased during earnings week, right? I'm not going to go into why, but it is. If you take a look at the week after, it's only 82%, right? It's a lot less. Now, I'm not lying when I'm saying that, implied volatility, usually goes in hand with earnings, right? If you take a look at AT&T, which is a stock that's very steady, right? If we look in the last month, there are no huge price swings here, right? And if we take a look at what implied volatility is for AT&T, so you can see it's a lot less, 22.28, because there isn't an expected huge price swing on it, right? So it's definitely something you should always take a look at. Now, let's go back to that AMD. Actually, this is calls, right? So selling puts, implied volatility, 22%, right? Now, let's go back to AMD and let's take a look at the Greek that I talked about so you guys understand what that means, because that's also something you should take a look at. So if we go back to selling of puts, and let's go back to this one. So what is this? So this is going to tell you how much the price is expected to change with a 1% change in implied volatility. Okay, so implied volatility here, let's say it's 101%. Let's just round it off to the nearest whole number. So let's say it goes up by 1%. Let's say it's 102% all of a sudden. The price of this contract is going to increase by 0.0381, right? So this would now be 3.69 almost, right? And then the opposite is true. If this goes down by 1%, so if it goes from 101 to 100, this is going to go down by this much. So it's going to be 3.61 almost, right? And so that's important to note, because again, on earnings week especially, right, as you get closer to earnings, this implied volatility is going to keep getting higher and higher usually, right? Which means Vega is going to keep increasing this, and it's going to keep going up and up and up even more. Right after earnings, usually implied volatility goes down a lot. And so every time this goes down by 1%, the price of this contract is going to go down by that much. And that's very useful information. And you can use it differently depending on whether you're buying options or selling options. But especially when you're selling a put, you want to know how much risk there's involved, especially with the price of the contract. Okay. So these are two things you should always take a look at: implied volatility, right? This is going to tell you how likely it is that it's going to swing in either direction. And again, the higher it is, the bigger the price swing is expected to be. So if implied volatility is high, I would definitely stay away from that. Okay. And then again, Vega is going to tell you how much it's going to increase, how much the price of the contract is going to increase or decrease by with a 1% change in implied volatility. Okay, so two things to take a look at. Keep in mind, I would avoid selling puts or trading options in general during earnings week. And as always, if you have any question, if something doesn't make sense, feel free to leave a comment in the comment section below. But let me know what you guys think about this. If you guys want to join my Discord, I'll put a link to that in the description below. I do have a free version and a premium version. Go ahead and check them out if you like. Also, if you plan on using Robinhood in the future, feel free to use my referral link in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is free money for both of us. So let's help each other out, guys. And as always, I hope you enjoyed the video, and I'll see you guys next time.